Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 342 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including warning signs for the market, volatility, and what it's saying about stocks, and keeping your accounts secure. Whether you're turning in for market insights, planning tips, or just staying informed, there's something here for you. So good morning, Matt.
Good morning, Mark. I'm still waking up. I was up late last night. I took Rowan to that Miami SMU game at UD Arena for March Madness.
Yeah, really cool that we always get the first four here in Dayton, or at least the contract was extended recently. So it's an electric atmosphere, it sounds like, and got to watch a little bit of it on TV.
It was fun. My first March Madness game at UD Arena. It was fantastic.
Yeah, good.
Fantastic.
Good. Did Rowan have a fun time?
Oh, made some core memories.
Good.
You know, the Miami fans were quite boisterous, as you can imagine.
Yeah.
So he definitely made some memories.
Good.
Yeah.
Good. Was he up and at 'em this morning?
It was a struggle.
Yeah,
it was a struggle at the Jessup household this morning.
It didn't start till 9 o'clock?
Yeah, the game didn't tip off till like 9:10, 9:15.
Yeah.
And I want to say we left the arena at like 11:30. I got home at 12:10.
Yeah.
Yeah.
Interesting.
It was late.
Interesting.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Well, as always, we will review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from YCharts and as of the market close on March 18th. S&P 500 index down 3.7% for the month of March and down 3.2% on the year. The Dow Jones Industrial Average down 5.6% for the month and down 3.8% for the year. The NASDAQ Composite Index down 2.3% for the month and down 4.7% for the year. The Russell 2000 Small Cap Index down 5.9% for the month and down 0.1% for the year. Then the Vanguard All World ex-US Index Fund down 7.9% for the month and still positive 2.4% for the year.
Those oil prices just hammering international stocks.
Yeah, right now it's not pretty for international. So 3-month Treasury rate at 3.73%, the 2-year rate at 3.76%, and the 10-year at 4.26%. So obviously big headlines and current events, Matt. Things still going on in the Middle East. And I think it was yesterday, oil spiked above 110 again, as you alluded to. Other big news from this week is the Fed held interest rates steady at their target range of 3.5% to 3.75% during its meeting earlier in the week, which was widely expected. And this is the second straight meeting with no changes in rates. And, Powell stated that inflation remains somewhat elevated and is not coming down as quickly as he had hoped. But he did mention the economy was performing with, quote, solid growth, largely driven by AI data center expansion and resilient consumer spending. One of your favorite things that we like to talk about here on the podcast.
Absolutely. Man, the American consumer is so resilient. I mean, just think about the last couple of decades, Mark, and how many headlines, and the consumer just keeps on chugging.
Yeah, it's been pretty impressive. So, again, there's going to be a lot of noise out there. Volatility is elevated. Typically volatility does increase around Fed meeting dates, but even, going into it, it was elevated because of what's been going on geopolitically. So kind of just a little bit of a turbocharged reaction or move to the downside after that announcement was made by the Fed yesterday.
I think that's well said, Mark. I think in these times of more bold or extreme geopolitical headlines, the headlines that most people see are the more dramatic on either side. And what I mean by that, it's either, oh my gosh, the price of oil is going to stay elevated above $110 a barrel for this period of time, and this is what it means for the global economy. Or you see the extreme on the other side, that they will have a quick resolution in X amount of days or weeks. You don't see much in the middle. In the resolution tends to be something that's in the middle. So I just want to caution people to be careful jumping with one side or the other and then just automatically being like, I'm all in on that decision, because these headlines change so quickly right now. Be focused on the long term.
Yeah, which I know we both have some pieces that relate to that here in a little bit.
Yes.
But moving on to tweets, articles, and research from this week, the first thing I had was a post on X from Ryan Dietrich at Carson Investment Research. So he says the S&P 500 just closed beneath the December low in Q1. When it breaks, like it did this year, the average full-year return is just 0.2% and up only 50% of the time. File this under potential caution, but of course, we saw this last year also, and things came back. So, Matt, I'm not going to get into all of these, but there's several indicators at the beginning of a year and the end of the previous year that we look at to give us an idea of how the new year might play out for stocks. One's the January barometer, one's the Santa Claus rally indicator, one is the December low indicator. We've talked at length in previous podcast episodes about those, so if you want to learn more about that, you can check those out. But for this instance, what Ryan is saying is in the first quarter of the new year, if the market breaks its December low from last year, things or returns don't tend to be as strong as they would be if it had held that low. So specifically, when the market stays above its December lows in the first quarter, the average return is almost 19% per year, and the market's higher almost 95% of the time. And like Ryan said, when it breaks below that December low, stocks on average are only up 0.2% for the year and only higher 50% of the time. But again, it's important to point out what Ryan did is the same exact thing happened last year, right?
Correct.
And fast forward to the end of the year and the market was up double digits. So this is not a panic and sell everything indicator. It's just another piece of information that we have to make an informed decision going forward.
Well said.
When we're building our general investment thesis.
Well said. I have nothing to add to that.
Okay. Second thing that I had, a couple of posts that I saw about the VIX or the volatility index. Again, very quickly, volatility index or the VIX index is the fear gauge in the stock market. When the VIX rises, stocks are usually falling and vice versa. So during times of geopolitical events, market stress, economic stress, the VIX essentially is pricing in what the downside risk is over the next 30 days for stocks, right?
Okay.
And the first thing that was catching my eye was a post from Seth Golden, and Jenna will put both of these charts up on the YouTube page if you want to check them out. But essentially what Seth was saying was that on Monday, the VIX, and this was 2 weeks ago, the VIX fell 25% from its high. And historically, that's very bullish for stocks. The 1 month forward return for the S&P 500 is up 90% of the time, and 6 months forward higher 95% of the time. So what this really means in layman's terms is there's a quick spike up in the VIX, and then it seems like people overreacted and that volatility index fell back down and stocks rallied. So typically when we get those big spikes forward returns tend to be pretty good. And this isn't the only piece on the VIX that I've seen like this. And again, not saying we're at a bottom or even near a bottom, but we start to see this type of behavior from the volatility index when we are getting closer to a bottom.
Well said. You explained that perfectly for our listeners and viewers. I'll take it one step further, kind of what I'm hearing on the street. So back a couple decades ago, you'd have what we call the taxi cab effect, which is if you're in New York City and get in a taxi cab, all of a sudden, if the driver is giving you stock tips or talking about the market, you tend to be at a peak extreme one way or the other. This trader I follow on X posted that he got on a flight, was sitting in first class, pulls up the stock market on his phone, flight attendant walks by before the flight is even about to take off, looks down at his phone and goes, "Huh, you better be owning puts like I do right now. This market's going to go down further."
Really?
What does that tell you?
Wow.
Right?
Yeah, that tells you a lot.
Tells you a lot.
And similar to that, one of our favorites that posts a lot of really good data, Subu Trade on X, he said the VIX is above 30 for the first time since April. So if you remember, that was when the tariff-related sell-off happened,
Yes.
right? He said after similar VIX spikes, the S&P 500 was higher 11 out of 12 cases 1 week and 1 month later. So this is talking a little bit about shorter returns, but kind of similar to what Seth was saying. When we get these quick spike up and then the volatility index drops, typically that's a good sign going into the future. So
Well said.
I don't want to make this sound like we are, pounding the table that this is nothing other than just a 5, 6, 7% sell-off, because it definitely could turn into something larger than that. But now we are starting to see signs over just the past week of, hey, typically this type of stuff happens when the worst of it might be behind us.
You articulated that perfectly.
So last thing I had, and kind of going back to what we were talking about with, oil and everything, this was a post on X from Sam McCallum back on March 9th. Jenna will throw this up on the YouTube page. It'll be in our show notes. But essentially what this is showing is just a chart of crude oil spiking to about, $120 a barrel last Monday. This was March 9th. And then falling below 100 on the same day.
Yeah, I talked about this on the podcast.
And you did. So, one of the things that I thought was interesting about this was Jim Cramer, very popular media person in our industry.
Yes.
Posted on X, the night before this happened: fear tonight of more energy infrastructure targeting and no way to open the strait. A sudden oil shock is always bad for stocks. I don't see a path to de-escalation. So it was just funny that, that was not even 24 hours before this price action in the oil markets occurred. And, this isn't me dunking on Jim Cramer or calling him stupid. It's just another reminder that it's really hard to time tops and bottoms in any market that
Let alone
you're looking at.
geopolitical headlines like this.
And you could be the smartest person in the world and have all of the available information, and the market can do the complete opposite of what actually makes sense in your head.
You want to be humbled? Start managing client money.
All right. Yeah. So, and it doesn't just apply to stocks. We're talking about the oil markets right now. You can talk about bonds. You can talk about commodities. You can talk about real estate and go down the list. It's just a really hard thing to time, but for whatever reason, it's sensationalized that it's the hot, cool thing to try to do, and actually could get you into quite a bit of trouble.
Yeah. I mean, let's just take oil. Let's take it a step further. Let's say you're someone who's trying to speculate right now purely on oil. Dangerous. Could you see those prices continue to head higher as the conflict gets prolonged and they don't have a lot of ships rolling through there? Absolutely. All it takes is a couple of headlines, just like you saw a couple of weeks ago, and you could see a double-digit correction in hours. It's just it's an environment where it's hot money. You've got to be really careful.
Yeah, and it's a perfect example of, you think you could have all the information available right now to make the decision, and then oh, tomorrow morning, the U.S. announces that it's ramping up its energy production. So there's going to be more supply online. So what's going to happen to the oil prices? It's going to come down.
Yeah.
So it's like the stuff changes so quickly and things that are out of your control that it...
Or you have a massive agreement between Russia, the U.S., and China. I mean, there's so many variables that could happen.
Right.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
All right, my first piece is going to mimic a little bit of what you were talking about with the VIX or the volatility index. But this piece that I have has to talk about the point change in the VIX in the first 45 trading days of the year. And the reason I'm highlighting this is since 1991, this is the third highest start to the year for the VIX. The highest was in 2020 due to the COVID fears, followed by 2022 during the inflation shock. Jenna will put up this illustration for our YouTube viewers, and this data is as of March 9th. So why am I highlighting this? I'm going to yell off some of the years of this data set, okay? 2020, 2022, this year, 2026, 2025 with, you saw all the tariff-related items, 2009, 2018, 2008, 1996, and I'll stop there. This is not normal, right? Mm-hmm. And that's my point with this is an abnormal type of market activity, and I want to be careful people don't overtrade in this type of environment, which leads to my second item. Bespoke had a piece, and I'll timestamp this, March 14th at 7 p.m., and they're talking about standard deviation movements on the 50-day moving average for the S&P. So I will explain this in plain English here in a second for our listeners and viewers. But it goes on to say that on average, and I'll explain this in a second, the S&P 500 is 18.9% below its 52-week high on average. So almost a bear market when we trade 3 standard deviations below the 50-day moving average. Right now, we're in that environment, and the index is off 5% from its 52-week highs. We've only seen this a couple of times since 1928. So I have a piece prepared I want to talk through because the indices itself, I don't think, are telling the full picture of what's going on in the market, okay? So I'm going to discuss this. I think it's been bugging a lot of us who watch the markets closely. You know, again, the headlines say, these are my prepared remarks, the S&P 500 is only a few percentage points off its all-time high. Nothing too dramatic, right? As of mid-March here in 2026, we're sitting around, 6,600 to 6,700 in the S&P compared to the recent peak of a little bit around 7,000 back in late January. It's roughly 4 to 5% dip. On the surface, it looks like a garden variety pullback. No big crash, no big panic. But underneath, it feels a whole lot worse. There's a killer chart and the stat that is talked about from Bespoke that exactly explains this. They point out that just last week, around March 13th, the S&P 500 closed more than 3 standard deviations below its 50-day moving average. Now, don't worry about the math. Standard deviation here just means way, way outside the normal range. Think of it as the market getting extremely oversold in a very short time period. Since 1928, this kind of extreme reading has only happened a tiny fraction of the time, less than 1% of all trading days. When it's happened historically, the index is usually getting crushed On average, I'm using crushed appropriately, Mark, on average, it's been down around 19% from its 52-week high. We're talking deep bear market territory, or at least a solid 10 to 20% correction. The chart they shared shows bars going back decades, and most of those extreme oversold days had the market down 20%, 30%, and even 50% from its peak. But right now, we're only down 4 to 5%. That's almost never happened before. And there are only a couple of other times, nearly 100 years, where the market got this technically wrecked, yet stayed close to the highs. So what does this tell us? The headline number, the big market cap weighted S&P 500, is being held up by a handful of the largest stocks. Meanwhile, the broader market, the other 490 or so companies, is hurting a lot more. Fewer stocks are participating. Breath is bad. It's narrow leadership, where a few mega cap masks the weakness everywhere else. This is the classic, the index isn't lying, but it's not telling the full story setup. Listeners, if your portfolio feel like it's under more pressure than the headlines suggest, you're not imagining it. Mark, due to compliance reasons, I can't specifically mention JWM portfolio performance, but what I can say is I'm very pleased with what you've done so far from a CIO standpoint for the firm. And if you're out there as an individual investor navigating this market and you see the index down 4 or 5 and you're down, double digits, you're not hallucinating, right? Underneath the surface, things are quite challenging. Your comments?
Yeah, it's, I feel like whenever we have sell-offs like this, people are always talking about, which part of the market is holding up and which part is not. And more often recently, I would say over the last couple of years, it's been the largest and most powerful names in the market, names that everyone can probably rattle off the top of their heads. But, there are certain instances where it's been the opposite, where it's been, the majority of stocks holding up the index and some of the larger ones have been struggling. And that's not to say some of the larger big boys haven't struggled, because they have.
Absolutely.
But a lot of that damage, in my opinion, was already done in Q4 last year and earlier this year, and those names are starting to look more attractive. And that was the time when breadth was really good, right? So a lot of the big boys were struggling in Q4 of last year, but the rest of the market picked up the pace.
Well said.
So it kind of masked what we saw in terms of performance for the S&P 500 in Q4.
Well said, Mark.
So,
my last piece before, if time permits, a financial planning topic of the week, or we can cut it, Mark. This piece is going to be titled, "Everyone's Suddenly an Oil Expert." Right? Funny how that happens.
it is.
So there's a lot of terms in oil that are being thrown around. And I saw this X post, Mark, by Michael McDough. McDonough. I want to be very respectful. But this post caught my eye because it explains the different oils, okay? So I'm going to go through this and explain it. So he has a post about what's Brent, what's WTI, etc. So let's go through this. I think it'll be good for our listeners. So Brent oil, or crude, that is going to be the world's, quote, default oil price. Most global trade is priced off of this. So when they say oil's at 108, they usually meant Brent. WTI, that's the U.S. benchmark. That's West Texas crude. It's based upon crude delivered to Oklahoma. It's the lowest line on this chart that I can reference here in a second, because American oil doesn't need to go through the Persian Gulf right now. Murban, this is crude from Abu Dhabi, delivered from the Fujairah port. Am I saying that correct?
You're doing your best.
Yeah, I mean, all of a sudden everyone's an oil expert, right? Which sits around the strait. Even though technically doesn't have to pass through the choke point, drone strikes have hit this port recently, pushing up insurance and shipping cost. Oman, this is the key benchmark for heavier crude sold into Asia. Many refineries in China, Japan, South Korea are built specifically to process this grade. It's the highest line in the chart because Asian buyers are competing fiercely for this shrinkage pool of the cargoes. Last but not least, you have Dubai oil. It's used to price most long-term Gulf to Asia export contracts. It tracks alongside the Oman crude. So there are, multiple 5 different types of oil that is discussed in the markets. I just want to throw it out that when you hear oil and people see that price of 108, oil here in the States is usually priced off of West Texas WTI, which because of the proximity and the geopolitical premiums a lot less obviously here, it's not priced as high. I just wanted to throw that out there.
Yeah, it's a good point. I have seen, a ramp up in people posting about oil that I've never seen post about oil before. So it's just funny how that works. It's just, I don't know, maybe it's just an innate human reaction that, you have to, or you feel compelled to talk about the things that are the hottest topics in your industry or in your line of work right now. But a lot of times it's just like, most, and I want to be careful here, most of the information coming out, I personally think about oil is not really going to totally derail someone's financial plan or cause them to make different decisions.
This is important.
Than what they've already made. And I want to be careful in saying this isn't going to affect you because we've already seen gas prices rise. So I'm aware of that, right? But I'm talking about someone's long-term financial plan. These oil spikes that we're experiencing right now, in my opinion, shouldn't be a factor in you making a decision of, do I need to change this or do I stick to what I was doing before this conflict started?
No, I think it's well said, Mark. I think what's happening in the financial news media is the producers of these shows are finding older oil traders who are upset that oil's been out of the spotlight for decades and that they are just ready and hell-bent on talking about how important oil is. And I'm not saying it's not. It's super important. But they're getting on there and they're talking about how we're going to go through, which is a multi-year, global, recession. Is that possible? It's possible all the time.
Yeah.
But when you see these spikes in oil and then you're only hearing that side of the story, that weighs on market sentiment.
Yeah.
Right?
Yeah. Yep. Well said. Lastly, quick financial planning topic of the week. This was from a newsletter written by Mike Piper at the Oblivious Investor on March 9th, titled Authenticator Apps, a much better multi-factor option than text or email. So cybersecurity is a hot topic in our industry right now. And, I think it should be because of the pickup in cyber attacks over the past several years. I just thought Mike wrote a really good newsletter about the best ways to protect your accounts with MFA or multi-factor authentication. Mm-hmm. So it's a little bit of a different planning topic for this week, but something that I think everyone should be paying attention to. So he says, when a website requires someone to set up multi-factor authentication, it often provides multiple options, such as email, SMS, which is texting, or an authenticator app. Of the three, using an authenticator app is definitely the most secure approach. The problem with email as MFA is as follows. Email as the multi-factor authentication method is pretty bad. Just think of how many websites you visit where, 1, your username is your email address, and 2, when you click the forgot password link, they just send an email with a reset password link. If those things are true and you use your email as the multi-factor authentication method, if a thief gets into your email account, they can now access any of those other accounts as well. Number 2, SMS or text isn't secure. The Cybersecurity and Infrastructure Security Agency, which is a component of the United States Department of Homeland Security, put out a document in December of 24 that encouraged people to migrate away from SMS-based multi-factor authentication. They note that SMS messages are not encrypted. A person with access to a telecommunication provider's network who intercepts messages can read them. And they also note that SMS is not phishing resistant.
Okay.
So that leads us to authenticator apps. Authenticator apps are more secure than SMS or email as MFA methods. The authenticator app is installed on your phone and cannot be accessed remotely, short of your phone itself being infected with malware. To get an MFA code from an authenticator app on your phone, the thief would have to, 1, be in physical possession of your unlocked phone, or 2, convince you to give them the code. Authenticator apps take a bit of time to get used to, but once you're used to using one, it's quite easy. I've found, and this is Mike speaking, the Google Authenticator to be easy to use, but there are many other options as well, like Microsoft Authenticator. If you're new to it, don't worry. Regardless of which authenticator app you pick, there will be a ton of intro/walkthrough videos on YouTube. So for our day-to-day, Matt, we use MFA and we have authenticator apps. And I can relate to what Mike's saying, because at first I was like, this is just another pain in the you-know-what. It's another step that I have to do.
Yes, sir.
But now that we've been doing it for so many years, it's just kind of part of the process, I would say.
I would agree.
So for different websites, we've used Google Authenticator, we've used Microsoft Authenticator, and we've used a couple of other ones that I can't name off of the top of my head. They're all pretty much the same.
They are.
If you can work a smartphone, you can work an authenticator app.
Sure.
It's just getting it, set up and connected in the first place, which just takes a couple of minutes. So I just...
Nice different piece.
Yeah, different type of piece, but, I think it's important with how much of an emphasis is being put on data security today. Mm-hmm. It's just another simple thing, I think, that you can do just to have that higher level of protection for yourself.
Absolutely agree.
So, anything else before we're done for the week?
No.
So I hope everyone enjoys their weekend, enjoy the college basketball and warm weather hopefully coming. And thanks everyone for listening to episode 342 of the Independent Advisors podcast. Catch us next week for episode 343.
Let's go, Wright State.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.